Welcome to the Deep Dive. Today, we're going to be tackling some smart investing strategies.
Okay.
And I think this is going to be really interesting for our listener.
Yeah.
They sent over some excerpts from William Bernstein's book,
Oh,
The
yeah.
4 Pillars of Investing.
That's a good one.
It is a good one. And we're going to be zeroing in on,
Yeah.
market bubbles, crashes,
Oh, yeah.
that tricky thing called investor psychology.
Oh, man. Yeah. It's funny how often we forget
Right.
that markets are driven by human beings, not just algorithms.
Yes.
Emotions play a huge role.
Totally.
And Bernstein, I think, does a really good job of unpacking that.
Exactly. So our mission today is to help you,
Yeah.
our listener,
Right.
understand how those historical market cycles and psychological traps can really impact
Oh, yeah.
your investment outcomes.
For sure.
And hopefully by the end of this, you'll be armed with the knowledge to make some seriously smart decisions.
Absolutely.
Yeah.
One of the things that really jumped out at me from Bernstein's book is how history just seems to repeat itself,
Yeah.
especially when it comes to groundbreaking technology. Think back to the dot-com bubble,
Right.
where valuations went through the roof.
Yeah.
Bernstein argues that similar patterns
Yeah.
played out centuries earlier.
Okay, well, give me an example.
Sure. So he talks about this diving company bubble in the 17th century.
All right.
This guy, William Phipps,
Okay.
salvaged a ton of silver from a Spanish shipwreck. And suddenly everybody wanted in on the treasure hunting action,
Oh, no.
pouring money into diving companies, even if those companies had no real plan
Wow.
for finding treasure.
So basically, it's the same shiny new tech syndrome we see today.
Exactly.
Just swap sunken treasure for the latest gadget
Yeah,
or app, and you've got the same recipe for a bubble.
that's it.
Everyone gets caught up in the hype and forgets about realistic valuations.
Forgets about the fundamentals, right?
Yes.
Bernstein lays out these criteria for bubbles
Okay.
called Minsky's criteria. And it's almost eerie how they apply to both the diving company frenzy
Right.
and modern bubbles.
All right, let's break those down because I think this is super relevant to anyone listening who's thinking about investing,
Absolutely.
especially in new technologies.
Especially in new technologies.
What's the first criteria?
Well, you often see technological displacement,
Okay.
where a new innovation comes along and disrupts an existing industry.
Mm-hmm.
Think about how the internet changed the game for so many businesses.
Okay, so that's the initial spark.
Right.
What happens next?
Well, easy credit is often the fuel that fans the flames of a bubble. When it's easy to borrow money, people are more likely to make risky bets,
Yeah.
driving prices up even further.
Oh, yeah.
We saw that with the housing bubble in the mid-2000s.
Right.
And you could argue we're seeing echoes of it in some corners of the market today.
Right, so we've got disruptive tech,
Yep.
easy money.
Mm-hmm.
What else?
Amnesia for past bubbles.
Mm.
It's like people forget that bubbles can and do burst.
Yeah.
And they get swept up in the euphoria of the moment.
Yeah, it's easy to see how that happens,
Yeah.
especially if you're new to investing and haven't lived through
Right.
a major downturn.
Exactly. And that brings us to the fourth criteria, an influx of inexperienced investors.
Mm-hmm.
When everyone's talking about how much money they're making in the market,
Right.
it's tempting to jump in,
Yeah.
even if you don't fully understand the risks.
This is all ringing some serious alarm bells for me,
I bet.
especially considering all the hype around certain sectors right now.
Yeah.
But there's a bigger point here, right?
Yeah.
Even if a technology is truly groundbreaking,
Uh-huh.
the early investors aren't always the ones who benefit the most.
Absolutely. Think about the internet.
Right.
Did the people who built early websites necessarily become billionaires?
Mm.
Or was it the companies that leveraged the internet to connect with customers
Yeah.
and build global businesses?
So you're saying even if you believe in the future of a technology,
Yeah,
that doesn't mean you should throw all caution to the wind and buy into the hype.
right. You really have to separate the potential of the technology
Right.
from the frenzy in the market.
That's a crucial point.
Yeah, and this leads us to another fascinating insight from Bernstein.
Okay.
The connection between market optimism
Mm.
and future returns.
Okay, so is this where we talk about that whole buy low, sell high thing?
It's a little more nuanced than that.
Okay.
What Bernstein highlights is that periods of high market optimism
Yeah.
often signal lower future returns,
Mm.
while times of pessimism can offer the best buying opportunities.
Really?
This seems counterintuitive, right?
It does. You'd think when everyone is feeling good about the market,
Yeah.
that's the time to invest.
Right.
So why does optimism signal lower returns?
Well, when everyone is already bullish
Mhm.
and prices are high,
Right.
there's less room for growth. It's like buying a house in a red-hot real estate market. That's right.
You're paying a premium,
Yeah.
and it might take a while to see significant appreciation.
Okay.
So,
So if I'm hearing you correctly, times of fear and uncertainty, when everyone else is running for the hills,
right.
those are the moments when some of the best opportunities emerge.
Exactly. Bernstein tells this amazing story
Okay.
from a 1979 Business Week article
Okay.
called The Death of Equities.
The death of equity.
And it was published right before a massive bull market.
Wow.
But at the time, sentiment was incredibly bearish.
So people were actually proclaiming the death of stocks.
It wasn't just a catchy headline.
Oh, wow.
Investors were convinced stocks were finished.
Really?
They were fleeing to real estate, gold, even diamonds.
Oh, my gosh.
They were selling low out of fear,
Hmm.
missing out on the huge gains that followed.
That's such a powerful example of how our emotions can lead us astray,
Yeah.
even when logic might suggest otherwise.
Yeah, for sure.
But how do we actually recognize these opportunities amidst the fear and uncertainty?
How do we know it's not really the death of equities this time?
That's where understanding historical market cycles comes in.
Okay.
It's not about predicting the future,
Right.
but recognizing that markets tend to ebb and flow. Periods of extreme pessimism are often followed by periods of growth,
Okay.
and vice versa.
So it's about recognizing the cyclical nature of markets
Yeah.
rather than getting caught up in the headlines
Right.
and short-term noise.
The short-term noise, exactly.
Precisely remember, in the 1930s,
Oh, yeah.
during the Great Depression,
Uh-huh.
stocks were so undervalued that even Benjamin Graham,
Yeah.
the father of value investing,
Right?
was recommending that conservative investors hold at least 25% of their portfolio in stocks.
I know, it's pretty amazing.
Wow, that's a bold call.
Yeah,
During such a tumultuous time.
it is.
He must have had a strong conviction about the long-term potential of the market.
Well, he understood a fundamental truth about investing
Okay.
that we often forget. There are no inherently good or bad stocks, only good or bad prices. And when fear drives prices down,
Yeah.
that's when savvy investors can find real bargains.
Okay, so understanding historical cycles,
Uh-huh.
recognizing the potential in pessimism,
Right.
and looking for good prices.
Absolutely.
Those are all key takeaways.
Those are key takeaways.
But what about managing risk?
Yeah,
That's the part that always keeps me up at night.
I hear you.
Yeah.
Well, Bernstein addresses this directly,
Okay.
explaining that over the long haul, risk and return become intertwined. The key is to have a clear asset allocation strategy.
So basically a plan for how much risk I'm willing to take on
Yes.
and how to spread my investments.
Exactly how to spread your investments across different asset classes.
Right. He dives deep into the nuts and bolts of building a diversified portfolio.
He does.
U.S. stocks, foreign stocks, bonds, maybe even a little bit of gold.
A little bit of gold, right?
But the diversification isn't just about minimizing risk, is it?
No, it's not.
I remember reading that it can actually boost returns, too.
That's right. It's through this process called rebalancing.
Okay.
So you start with your desired asset allocation.
Mhm.
Let's say 60% stocks and 40% bonds.
Okay.
Over time, some investments will perform better than others,
Right.
shifting your portfolio out of balance.
Gotcha.
So you periodically sell a portion of your winners
Okay.
and buy more of your losers to bring the portfolio back to that initial 60-40 split.
So you're essentially buying low and selling high,
Exactly.
which can smooth out returns
Mm-hmm.
and potentially boost your overall performance over time.
Over time, that's the key.
That makes a lot of sense.
Yeah,
It takes the emotion out of the equation
it does.
and helps you stick to your plan,
Yes.
even when the market is throwing curveballs.
Exactly. Even when the market is throwing curveballs.
So where does the coward's portfolio fit into all of this?
Oh,
I
yeah.
remember you mentioning that earlier.
Yeah. Bernstein presents it as an example of a very conservative portfolio,
Okay.
designed for people who are extremely risk-averse.
Okay.
The interesting thing is,
Yeah.
this coward's portfolio actually performed surprisingly well over the long term.
Yeah, I'm really curious.
Yeah.
What exactly is in this coward's portfolio?
Yeah.
Is it just all cash and bonds?
Not exactly. Bernstein suggests a mix of U.S. stocks, short-term bonds,
Okay.
and long-term bonds, all held in low-cost index funds.
Okay.
It's not flashy or exciting,
Hmm.
but it provides a level of stability
Right.
while still allowing for growth.
So the lesson here is that you don't have to be a daredevil
You don't have to be a daredevil.
to be a successful investor.
No.
It's more about understanding the basics,
Yeah.
Having a plan
Having a plan.
and sticking with it through thick and thin.
That's the real secret sauce, isn't it?
Yeah.
Discipline and patience.
Mm.
Resisting the urge to chase the latest trends
Right.
and staying focused on the long game.
Which is admittedly easier said than done
Yeah.
when you see other people making a killing. On the latest meme stock or crypto craze.
It's hard not to feel like you're missing out.
It's hard not to feel like you're missing out exactly.
Absolutely. And that brings us to another critical element of Bernstein's book,
Okay.
investor psychology.
Okay, so beyond discipline and patience,
Mm-hmm.
how do we actually outsmart our own brains
All right.
and avoid those emotional pitfalls that can lead to bad decisions?
Well, he goes beyond just listing those common biases,
Well-
like herd mentality or overconfidence.
Right.
He dives deep into things like recency bias,
Okay.
where we tend to overweight recent events,
Yeah.
and myopic loss aversion.
I've definitely been guilty of recency bias.
Haven't we all?
It's like whatever happened last month feels more important than what happened 5 years ago.
Yeah,
Even though that might not be logically true,
right.
but what's myopic loss aversion?
Myopic loss aversion.
It sounds terrifying.
It's the tendency to feel the pain of a loss
Okay.
more intensely than the pleasure of an equivalent gain. Basically, we hate losing more than we love winning.
And that can lead to irrational decisions in investing, right?
Exactly. It might make you sell a stock that's down,
Oh, wait.
even if it has long-term potential,
Right.
just to avoid the pain of seeing it go lower.
Oh, yeah.
Or it might prevent you from buying into a dip
Mhm.
because you're afraid of losing even more.
So we've got all these biases working against us.
We do.
It feels a bit like our brains are rigged for failure.
I know it's tough out there,
Yeah.
but not necessarily. Bernstein argues that awareness is the first step to overcoming these biases.
Okay.
Once you understand how your mind tends to trip you up,
Yeah.
you can start to develop strategies to counteract those tendencies.
Okay. So let's get tactical.
All right.
What are some concrete things we can do to outsmart our own brains
Okay.
and make better investment decisions?
One of the most important things is to have a written investment plan.
So having a plan helps to keep us grounded
Absolutely.
and focused on our long-term goals.
For sure.
It's like having a roadmap
Yeah.
that guides us through the ups and downs of the market.
Exactly. It acts as a pre-commitment,
Hmm.
helping you avoid impulsive decisions
Okay.
based on fear or greed.
Right.
Outline your goals,
Yeah.
your risk tolerance and asset allocation, and refer back to it regularly.
That makes a lot of sense.
Yeah.
What else can help us stay on track?
Well, Bernstein also emphasizes the importance of actively seeking out information
Okay.
that challenges your existing beliefs.
Hmm.
Don't just fall into the echo chamber
Right.
of confirming opinions.
Yeah.
Read diverse perspectives.
Okay.
Listen to opposing viewpoints.
Uh-huh.
And really try to understand the other side of the argument.
So basically, don't be afraid to have your assumptions challenged.
That's right.
That's where real learning and growth happen.
That's where the magic happens.
Exactly.
Yeah.
And it's okay to change your mind.
Of course.
As you gather more information and experience,
Absolutely.
it's about being open to new ideas.
Yeah.
And constantly evolving your understanding of the market.
That's the name of the game.
And another crucial piece of advice,
Okay.
focus on the long term.
Yes, focus on the long term.
The market will fluctuate,
It will. It always does.
but over time, quality investments tend to grow.
That's right.
Don't get caught up in the day-to-day noise.
Yeah, tune out the noise.
And definitely resist the urge to constantly check your portfolio.
so hard, isn't it?
It's so hard to resist that temptation, though,
I know.
especially when you see those numbers bouncing around every day.
It's like watching a tennis match.
Right.
But remember, you're not playing a game of points. You're
Yeah.
running a marathon.
Okay, so we've got a written plan.
Yep.
We're challenging our assumptions.
Yeah.
We're focused on the long term.
Yes.
Is there anything else we can do
Well,
to improve our odds of success?
there's one more thing that Bernstein touches on
Okay.
that might seem counterintuitive,
Hmm.
especially after everything we've discussed about bubbles and investor psychology.
Okay.
He calls it contrarian investing.
Now that sounds intriguing. Tell me more.
Okay, so it's the idea that the average investor
Yeah.
is often wrong. They tend to get caught up in the hype, buy high, sell low.
Right. All those classic mistakes we've been talking about?
Exactly, all the classics.
Right.
So a contrarian investor tries to do the opposite
Okay.
of what the crowd is doing.
So if everyone is panicking and selling,
Yeah,
a contrarian investor might see that as a buying opportunity.
that's the idea. They're looking for those moments of extreme pessimism
Hmm.
where high-quality assets are being undervalued.
Okay.
Of course, it's not as simple as blindly doing the opposite
Oh,
of
I see.
whatever everyone else is doing.
You have to do your own research
You have to do your research.
and understand why the crowd might be wrong.
Absolutely. And there's definitely a higher level of risk involved.
Right.
But Bernstein presents some compelling arguments for why this approach can be remarkably effective, especially over the long term.
I have to admit, that's a pretty fascinating concept.
It is.
It kind of flips the script on everything we've been talking about.
It does, doesn't it?
Yeah.
It highlights the importance of independent thinking.
Right.
And not just blindly following the herd.
So for our listener who's been taking all this in,
Uh-huh.
what's the one key takeaway you want them to walk away with?
I think the biggest takeaway is that knowledge is power in investing. By understanding historical patterns, psychological biases,
Right.
and yes, even exploring alternative approaches like contrarian investing,
Yeah.
you can make more informed decisions
Right.
and avoid some of the common pitfalls
Yeah.
that trip up so many investors.
It's about taking control of your financial future
Yes.
and not letting your emotions dictate your actions.
Absolutely. And remember, there's always more to learn.
Right.
Never stop being curious. Never stop questioning. And never stop seeking out new knowledge.
Beautifully said. And on that note, I think it's time for us to wrap up this deep dive.
Okay.
It's been a fascinating exploration of market cycles,
It has.
investor psychology, and some really insightful strategies
Yeah,
for navigating the complexities of the investing world.
absolutely. Thanks for having me.
I always learn so much from these conversations.
Me too.
And for you, our listener, we hope this deep dive has given you some valuable insights
Yes.
and actionable knowledge to help you on your own investing journey.
That's what we're here for.
Remember, it's a marathon, not a sprint.
That's right.
So keep learning, keep exploring, and keep diving deep.